All right, it's been a fairly quiet start to the trading day. Perhaps not a surprise. We're here in August, and the market, particularly in the U.S., came off that huge run-up in the first half of the year. And in a lot of ways, it feels like investors are trying to assess which pockets of the market could outperform for the rest of 2023. Let's bring in Brian Levitt of Invesco. He's a global market strategist there to talk a little bit more about what he's watching. Brian, what do you think? I mean, what would you be saying to investors who are curious about the balance of 2023?
And the economy is actually likely to be stronger than most people had expected. The inflation data is improving, which is a good sign. And month-over-month inflation is likely to be modest from here. And the Federal Reserve is either at or very close to the end of the tightening cycle. So you put that together, it creates a good backdrop for risk assets. Now, if you look at what performed well in the spring, it was largely a handful of names, the mega cap growth names. What we're expecting to see now and have been seeing for a bit now is a broadening out. So more exposure to those parts of the market that require some economic activity, value, cyclicals. And so we're optimistic for market performance between now and the end of the year.
You know, if I look at the Canadian market, we're just showing our TV audience a few different areas that you're thinking about: cyclicals, values, small caps, emerging markets, so many different flavors for people to try to get their head around. But at least in the Canadian market, which underperformed U.S. stocks because of that limited tech exposure, broadly speaking, and we saw, you know, groups like energy and materials struggle in the first half. Financials as well. Let's face it, the banking turmoil, we were reminded of it yesterday with a Moody's downgrade of some of the regional banks. Within those kinds of sectors, do you think they could outperform, let's say, big tech for the balance of the year?
We do, and that's precisely what the market has been telling us. Typically, when you see corporate bond spreads come in, which has been happening, you're seeing greater participation in markets. That is a market that's telling you, at least tactically, the economy is going to be better than what many had expected. And that creates more of a risk-on backdrop. Now, we had a similar signal February, March that suggested that things were starting to get a little bit challenging. Credit spreads moved out. There were concerns about the regional banks, and you wanted to be a little bit more defensive here. So for investors who are inclined to be so tactical, you'd want to be more exposed to cyclicals, the recovery trade, in a better economic environment. And of course, that would be some of the names that you would mention, such as energy and materials.
What, out of all the big headline risks or things to watch for, what are you watching most closely that really, in your opinion, could dictate some of the near-term performance in the stock market?
Well, we want to make sure that the inflation story is passé, and it seems like we're getting close to that. But of course, that's been the challenge that we've been dealing with, quite frankly, since the fall of 2021, has been policy uncertainty. And in order for the market to continue to move higher, you'd likely need to see a shift in policy stance. And I'm not surprised to see markets up as much as they are since last June. Markets almost always do well in the 1 year after inflation peaks. From there, what you typically get is a shift in policy and markets following through because of a more accommodative stance. So that's what we need to see. If, of course, the inflation data gets away from us in the wrong way and long rates have to adjust higher, that is not a good backdrop for risk assets. But our base case is the Fed's got the inflation story increasingly under control, and they start to shift away from the tightening stance, providing the next catalyst for markets to move higher.
And what's the one thing you wouldn't be doing right now?
The one thing I wouldn't be doing is probably what a lot of investors are doing, which is trying to take advantage of the inverted yield curve and keep their money very short. When you keep your money very short, seems intuitive because you're capturing a high yield without taking on much risk or any risk in most instances. But what you have, the risk you do have, is the reinvestment risk. And if we're right and the Federal Reserve starts to shift their approach, then the market will get out ahead of it and you'll see short rates start to come down. And as short rates come down, if you have your money in cash-like instruments, you'll be reinvesting lower. I would advise investors take advantage of the opportunities that present themselves. I mean, if you like 5% for 6 minutes, you'll probably like it for 6 years. And so look out to longer maturities, look out to be able to potentially lock in these yields in investment grade corporates and U.S. municipal bonds, because the opportunities are presenting themselves.
Brian, nice